With the market near all-time highs, it can seem impossible to find growth stocks that aren't expensive. They do exist, you just have to know where to look. I recently ran a stock screener with 5 criteria to find some of those really rare businesses. We're talking about companies with strong sales growth, excellent operating margins, and a forward price to earnings ratio of 20 or less. What I found are 5 profitable companies, several brands you likely know, that I think Wall Street is sleeping on as investments today. Let's take a closer look. Now, I used FinViz as my screener. There are dozens of free screeners just like this one out there, but FinViz is just one of my favorites. And here are the criteria I used. Number 1, a market cap of over 10 billion. That cuts out all the tiny companies without scale that might be benefiting from noisy accounting. Second, we want US-based companies. That's a universe of about 4,000 publicly traded stocks we can pick from. Third, sales growth. We want at least 15% per year on average over the last 5 years. That's starting at the end of the pandemic. So we want a long track record of expansion since then. Fourth, operating margins of 15% or better. This is the key metric for me. I do love to invest in businesses that can expand towards 20% or better profit margins. And finally, a forward PE of 20 or less, which is closer to what you might associate with a value stock than with a high growth stock. So let's walk through each name and see why it showed up in our screener. The first up is The Trade Desk. It's ticker symbol TTD. Now, The Trade Desk runs a huge platform for programmatic ad buying that helps brands and agencies buy digital ads across channels like smart TVs, mobile, and desktop. It's a company that's going through a rough transition period right now. Sales were up 18% last year and over 20% the year before, but there's a slowdown that's happening into 2026, and analysts are projecting gains of just mid-teen percentage rate in 2026. TTD is seeing more competition from companies, big companies like Amazon, but profits are holding up really well. The company has boosted margins in each of the last 2 years, even as growth has slowed down. So the big question for me on this stock is whether growth will stabilize in 2026 and start re-accelerating again as management is hoping. If that doesn't happen, I think returns are going to stay probably pretty weak on this stock, even though its valuation has shrunk so much in the past year. In any case, the stock looks more attractive at this multi-year low valuation. Next up on our screen is Deckers Outdoor, and the ticker symbol is DECK. It's the company behind the popular UGG and Hoka footwear brands. It's another slowdown story here, with sales gains decelerating from 16% last year to a little bit less than 10% right now. Worries on Wall Street include the fact that you could have a fad risk around footwear. Even Nike can't seem to grow over the long term in this industry after all. There's also the potential for a consumer spending slowdown, along with tariffs and trade wars, and you got rising costs due to inflation. But through all these risks, Deckers is posting great profit margin that's consistently above 20% of sales, and the stock looks downright cheap at a current PE of 14. That's a 5-year low for this really efficient business, if you don't mind holding through volatility during a growth slowdown. Next is Royal Caribbean, ticker symbol RCL. Now, Royal Caribbean is seeing really good demand for its cruise vacation packages, good spending on board in its ships, and really strong earnings, yet investors are valuing it at a huge discount compared to the past few years. There's a lot of concerns on Wall Street about rising fuel prices, the conflict in the Middle East, and stretched consumer pocketbooks. These issues did actually slow down bookings in March and early April, management said in late April. Yet demand has normalized since then, and they're calling for another record year in 2026. So this one is really worth watching in my view. The fourth stock on our list is Intuit, ticker symbol INTU. This is the tax preparation software giant, and it's really seeing excellent growth. Sales were up 17% this last quarter. Profit margin is fantastic too, at close to 30% of sales. So it's really a business firing on all cylinders. Now, growth isn't as fast as it was a few years ago, but Intuit is crossing 20 billion in revenue, or more than double the 2021 mark here for 2026. The PE ratio has never been this low either, and that's likely because investors are worried that AI will take over a whole lot of market share with some free analysis tools that might come out soon. But Intuit can also incorporate AI into its business, which it is doing. So if the AI fears don't come to pass, then I think this stock could really rebound nicely from this really sold off period. Next up is Booking Holdings, and it's the biggest stock on our list by far. It's the travel company behind Kayak and Priceline. Growth has been phenomenal since the pandemic. Sales hit 27 billion in 2025, up from 17 billion in 2022. I do like Booking's huge global market share and its scale and efficiency. It's highly exposed to consumer spending though, and a lot of geopolitical risks, of course, and that's a big reason why investors are worried today and why the stock has been selling off a bit. But cyclical slowdowns are really nothing to fear for long-term investors. The stock should do well, in my opinion, over the long term, and it is my favorite out of this bunch. So all 5 of these companies, The Trade Desk, Deckers, Royal Caribbean, Intuit, and Booking, have 3 things in common. One, they've delivered strong, sustained revenue growth since 2021. Two, they convert a huge portion of sales directly into profits. And three, they're trading at cheap valuations that are well below places where investors have seen them trading at in recent years. Now, this isn't a buy list, it's more of a watch list screener that you could say tilts the odds slightly in our favor as long-term investors. There's less of a risk, I would say, in overpaying for growth in these stocks because they're meeting these strict criteria. So if any of them caught your eye, use this list as a starting point for more research. Now, if you like growth but you don't mind paying a premium for it, then check out this video I did breaking down Microsoft stock. You'll see why I think that's a business really worth putting near the top of your watch list, and I will see you over there.